So let's discuss the global setup with Andrew Economos. He's head of sovereign institutional strategy with JPMorgan, joins us live from Hong Kong. Andrew, good morning and thank you for joining us. Andrew, developed markets are moving from strength to strength. Do you think equities as an asset class is benefiting because of this great sectoral rotation?
I agree. I think equities will continue to benefit. I think the Fed has done an excellent job, as have central bankers, with this portfolio rebalancing objective that they've had, moving us out of less risky into riskier assets, and fund flows have followed. However, I do expect we should see a slowdown in that equity action, probably going into the beginning of the end of this year. We'll see a pullback in the markets, a little bit of uncertainty around the global economic outlook, and then I think a continuation of the equity rally into 2014.
Andrew, what explains the price action in commodities, even though the problem in Iran has been put to rest for the moment? Crude prices have not crashed or corrected.
Yeah, the crude prices have been moving sideways. I mean, let's not forget for a moment that the world still consumes 91 million barrels of oil a day, so there is underlying demand. All we've done is put effectively a cap on prices, and as a result of it, crude has been moving sideways, both in terms of Brent as well as West Texas Intermediate. So prices are slightly going down. We've seen increased supply out of Iran. We've seen increased supplies out of Libya and now Venezuela, but ultimately, and Iraq, and I think ultimately we'll start to see prices come off. But again, oil is still an important commodity for the global economic system.
Andrew, what's the sense that you're getting in terms of how the dollar may pan out? Because that's going to have its repercussion on emerging market equities as well.
Right, I agree. I think the dollar will continue to move sideways to slightly weaker, only because the Fed obviously is on hold, probably for longer than most expect. And as a result of it, you should have continued dollar weakness. That said, interest rates have been ticking up in the markets, particularly in the United States, for the last 18 months. And as a result, that's given some support. So I think you'll see an orderly decline in the dollar, which is exactly what the Fed wants to do, to stimulate exports within the United States and to keep that risk-on trade and to force American institutional investors into overseas assets and push up prices.
So across global equities, which are the three markets that you're extremely bullish on, where valuations look attractive at this point and you would recommend buying into?
Well, I think it's easy. Generically, I mean, it's going to be equities in general. And I think within the markets themselves, I think you will see a rotation out of developed markets continued into emerging markets. That has been a weak point. The emerging markets have been a weak point in the equity story. And I think you'll start to see a mean reversion rally as developed markets come down a bit and emerging markets catch up. Within the emerging markets, I think you've seen a rotation into North Asia in particular. China is starting to catch a bit, and India has been a very good story, as you and I have discussed many times.
Andrew, so what could be the next needle-moving event for emerging markets? Because as of now, there seems to be a widespread acknowledgement that Fed will not taper in the first half of 2014, and whenever they will taper, that tapering has to be backed by solid economic data.
Right. I think the Fed is on hold for longer than most expect. The Fed in particular under Yellen now will be concerned about two things. One, the U.S. housing market, and number two, whether or not they can continue to prop up U.S. equities. That's in effect the wealth effect that keeps the U.S. consumer grounded and moving forward with confidence. The housing market has started to falter a little bit, so the Fed is focused basically on keeping up equities. That's good news, I think, for risk-on markets. So for emerging markets, they will continue to benefit from the Fed staying on hold and encouraging encouraging investors to rebalance their portfolio into riskier assets. And I think you've given time for the global economic activity to pick up, and that bodes well for emerging markets as well. So all in all, it should be the needle-moving event will be just generally improving economic growth and continued strong fund flows.
Andrew, I'm getting a sense from several market commentators that there seems to be a degree of global complacency which has kicked in. Global growth is still looking very anemic, and no one is bothered about the US debt ceiling issue which will surface up in the first half of Feb.
Well, it's not a question of not bothering with tapering, with the U.S. budget deficit issues. It's more that we as investors have begun to understand that there is some limited downside to these activities. In other words, we became, the markets got very volatile the first time these issues surfaced, and now that we've begun to discount them and digest them a bit better, then we're not as volatile, and we won't act as panicky around those particular events. So I don't think that necessarily that these events have become less important. It's just that we're able to digest them and move on. So there isn't necessarily complacency. There still is a lot of bearish sentiment, and the bears continue to be the smartest guys in the room. They've got very compelling arguments to keep us all very nervous, but fund flow is still very strong. Plenty of money on the sidelines, economic activity picking up, non-inflationary, benign economic policy, and federal central bank policy. That's quite good, background for equities and emerging markets in particular.